I think it's still not settled down.
It's not settled down.
For sure. Again, the problem was with few NBFCs. People don't have problem with at large most of the NBFCs.
Right, the top 5 or the top 10.
But the challenge is, you see, I think I'll go a little bit sidestep. While we call it all NBFC issue and all that, the real issue actually started 4 or 5 years back, right? When we started in AQR for the banks, right? And that is where, you had 11 bank PCA, you had 6 banks almost not lending because they were on the verge of PCA.
Right.
Effectively only 4 banks lending. And of that, maybe 50% plus was actually going to the government companies. So for private consumption, as I said, last mile, which was typically a nationalized bank would do it, right? That was completely missing.
Right.
Then of course we had GSTA and DEMO and all that, which created a lot of liquidity surplus.
Right.
And that's when mutual fund got money, banks were also surplus. That's where NBFC were able to create a lot of liabilities. Like Nirmal is there in this business, we were there a long time back. Liability in NBFC was the crucial. Growth was never a problem. It was basically, how to build the liability.
Right.
Like when we started, so there was liability on NBFCs was always a challenge. And your main source of funding, particularly for capital market real estate, would have been mutual funds.
Right.
And that's where it grew at a very large speed, which actually deferred our problem by a year.
Right.
Because banks not lending was a problem. So which actually deferred our problem by a year, because then NBFC stepped in. Even equity investors started thinking NBFC will take over banks last mile lending, and that was the motion, the view then, right? So therefore everybody thought, okay, fine, banks not lending, not a problem, but NBFCs will fill in their shoes. And that's when last year when we saw the problem, and that's where now the investors in mutual funds are actually asking mutual funds to be very, very cautious, like how many NBFCs you have, what kind of NBFCs you have. I think the total trust factor on the credit and credit rating by the mutual fund investors
right.
has been lost, and therefore naturally it will have a fall down effect on
right.
the lending. So there is no other, as of right now, alternative source which has been really built up for NBFC. Of course, I think RBI has announced ECBs and stuff like that, but how many of them will we really be able to access ECBs? I think till that settles down, we need to have a proper liability side framework for NBFC. Cannot depend only on mutual funds. So I think that's a big challenge.
Right.
So NBFC, I think now is almost 1 year since IIFL's default has happened.
Yeah.
And DHFL was known at that point in time also, in a way. And
sure.
If you really look at after that, no NBFC has actually defaulted as such. And Altigo is a small NBFC, and they also have 2,000 crore net worth, 4,000 crore debt. Is not really a
right.
disastrous case, but it happened because of certain other reasons. But having said this, I think the panic amongst lenders. So what has happened? Of course, the mutual fund money was short-term money.
Right.
And all the financial sector problems world over have happened because of this. That we borrow short-term, lend long-term, try to make arbitrage of low cost of funding and try to get higher.
Right, right.
So that was not a great practice. So I think that has changed structurally, and that has changed for good. So it's very unlikely that NBFCs will again get access to CPs or short-term funding from NBFCs,
right.
from mutual funds. And they'll build their long-term assets. It's not a good thing to do. But even after that, most of the banks are still in a panic or a completely paralysis mode. That they are not willing to give term loan to most of the NBFCs. Some of them who are loan, they are also panicking and saying that I want to have it
right.
adjusted or back.
Right.
I think so. That is causing more damage rather than anything else.
So that fear is still there.
The fear is still there. And then I think all the lenders, everybody has to act responsibly and not succumb to the fear factor,
right.
because that will only aggravate the problem. See, in the good NBFCs, like you see, Umesh has raised about $1.5 billion from
right.
external commercial borrowing or dollar bond issuances.
Right.
So I think as NBFCs now have 2 more sources of funds open up, which obviously have to diversify and can't be dependent only on banks or mutual funds or insurance companies. So you have a foreign source of capital.
Right.
And although the market is a little volatile, but still there's a market, ECB or dollar bond issuances. Then second is your public issue of bonds here locally.
Right.
And I think even that can become over a period of time. As of now, many retail investors would be also in a little bit of fear or a panic mode. So they put money in bank deposits.
Right.
But I think it's just a matter of time. So in a way, few structural things that have happened with NBFCs that will make this sector stronger. Of course, they can come out with schemes what they had before 2008, where they opened a window of lending, RBI itself, by a repo. But I don't know whether these measures are really required. But what is required is a more confidence and a more trusting environment, and give some time. I think most of this. I think that's one of the.
Right.
But I think government and central bank, they are doing their bit. It's very difficult to expect
Sure.
that they can do beyond this much. They can do a little
Sure.
bit more, but that's about it.
Not.